Hey there, everyone. Welcome to Chart This with Dave Keller. It's Friday, January 31st, the end of January. And welcome to this special all-mailbag edition, which we love to do every Friday here from a, kind of rainy Redmond, Washington. We haven't had rain here in a while. It's actually temperatures in the 40s. Smells like rain. It's a little wet outside. Feels more like Seattle this time of year. So it's a welcome return from the frigid, icy conditions we've had over the last week or two. Looking at the market conditions here as we open the mailbag, I would say, market kind of limping into the weekend as we track through the course of this week. So many different narratives from the DeepSeek AI on Monday really start over the weekend, but the market reaction on Monday with NVIDIA gapping down along with the other semiconductor stocks. We had the Fed meeting Tuesday and Wednesday. We had a bunch of earnings, including for the Magnificent Seven stocks, some taking their earnings releases and getting just more fuel to the bullish fire. Others getting somewhat destroyed in the short term, while still okay, I would say, from a technical perspective. Charts like Apple, like Microsoft, like NVIDIA still looking quite questionable here as we wrap up from the week. Market was overall pushing to new all-time highs. S&P was around 6120. Here we're recording this kind of afternoon Eastern time, and S&P, other risk assets like cryptocurrencies selling off here in the last hour. So we'll see what happens going into the close. I would say before we get to the charts and some comments, the questions. I just want to give a couple charts here. I mean, looking at the market misbehavior, market trend model, I mean, you can see that, for now, the short-term model kind of remaining okay. I don't formally update this until the close. It would take a significant sell-off going into the end of the week to change that. So most likely our market trend model is going to remain bullish on all time frames over the weekend. For my market misbehavior premium members, we'll give the formal announcement and review some of the implications of what we learned this week. But I would say initial assessment kind of looks okay. I mean, the S&P is testing 6,100. I kind of think of that as the upside line in the sand, I guess, right? I mean, the question is, do we get above 6,100 and hold it? I would say the S&P is kind of settling into that range between 5,850, maybe 5,800 on the lower end, on the upper end, 6,100. We're sideways. And a lot of big names are kind of sideways too, right? And I think that's the reality of the semiconductor space. The SMH, the stocks are essentially sideways trends here for a couple months. I think the market is still in wait and see mode. While you thought that maybe the Fed meeting would give us some clarity, I think it's still for a lot of investors, not a lot of big. We didn't see a big upsurge after the Fed, which we've experienced a lot of times in 2024. We'd have the Fed meeting and then this big acceleration in stocks. Definitely did not get that this time around. Now, granted, a lot of earnings to digest as well, but earnings were mixed from the big mega cap names here. So I think an open question. So no real change, I would say in terms of my general thinking here at this point. Although again, over the weekend, it's when I really take a few moments to really think a little more deeply about it. One other observation, and this is a nod to Carter Worth, who, for a number of years was at Oppenheimer, ISI, other different shops, now runs his own firm called Worth Charting, and is a fellow CNBC contributor. And Carter used to come through Fidelity when I was there about once a quarter, and his meetings were always well attended. It was a great discussion about stocks, and he would always do this rapid fire exercise of, would you rather own this or this? Would you rather own this or this? And it was a great way of just comparing how different stocks had very different paths in recent history. With that in mind, would you rather own at this particular point? Would you rather own a Meta making new highs, or a Microsoft at the lower end of its range for the last 6 months? Would you rather own an Alphabet making new all-time highs today, pushing above $200 a share, or an NVIDIA testing its 200-day moving average and really failing to regain any momentum after that gap lower? The reason why I show that is I think this is one of those times where the Magnificent Seven and friends, which I often think of like this group of mega cap names that kind of all move up and down. And at times it was most of the Magnificent Seven up and Tesla down, or, one name kind of moving. Now I feel like a lot of these are having very different trends over the last 2 to 3 months. And I think that's an important, maybe takeaway from what we've learned so far in January, is the Magnificent Seven are not one group. it's a group of stocks that at times move together, but often can move actually very differently. And I think this is one of those times where we're experiencing that particular phenomenon. All right, that's it for just some quick observations. Let's get to the first questions. As a reminder, all of these come from viewers like you throwing questions in during the live stream. Many of these come from our YouTube comments if you're watching the replay. So I appreciate you so much. Any questions you want to drop in any of those places, I'm thrilled to check them out and hopefully answer as many as I can through the course of a week. Dave, do you put more influence or weight on any specific indicators over other indicators, and does that change between stocks and indexes? I really appreciate your question here, really getting to the essence of technical analysis, particularly indicators and how we use them. I will tell you, I love how in the language of your question, I think you're implying a very important reality, which is you can't look at a bunch of indicators and kind of equal weight them. Because if you do that, you're going to basically what you will do is you are opening yourself up to confirmation bias and narrative bias and recency effect, and all of these biases that basically are very common when we just have too much information going, and so our brains kind of try to put order to it and help us just make a decision. It's really, given too many choices of car colors, it's really hard to pick your favorite one. If you have two choices, it's very easy to pick one or the other, right? And that is the same with technical indicators. I think one of the common rookie mistakes when people use technical analysis, they have a ton of indicators. Their charts are filled with stuff. And my initial response to any of my new premium members that share a chart with all the stuff I say, the first thing I say is, listen, you need to lose like half of those indicators because you're just duplicating, you're overlapping. Some of those are similar. This one and this one are pretty much the same thing. They're just calculated a little bit differently, but you're not really getting anything, unique from looking at the two of them. And I think that's how you want to think about it. I think you want to start simple and add a little bit over time. The daily chart that I show is really, these are the main indicators that I use. The only one that's not shown here, a couple that aren't shown here that I use kind of opportunistically if I think it's the right time. But my main look is usually a 2-year daily chart. This is a 1-year daily chart because I wanted to zoom into the more recent data here. But moving averages are a key part of it. And besides just looking at price, which I think is always the starting point, moving averages are really helpful for me because they help you cut through the noise and just look at the overall direction of the trend over a longer period of time. RSI is a measure of price momentum. This is a type of an indicator called an oscillator. And there are others out there like Williams percent R, the commodity channel index, stochastics, all very similar. RSI for me has been the one that I've used the most. And I use it because it's a great way of kind of normalizing the price action and just thinking, is this particular move unusual based on the strength that the stock or the chart normally portrays? And then at the bottom, and I would argue for an equity or ETF investor, probably the most important data point would be relative strength or relative performance. How is this stock or ETF doing relative to a benchmark, or basically doing relative to other stocks or ETFs you could buy at any given point? That's it for me. I mean, those are the main indicators that I use. And in terms of priority, I kind of go from top to bottom. I mean, I start with price as most important. Price pattern, support and resistance, breakouts. Randomly, I put like Fibonacci retracement just as a way of identifying key support and resistance levels. Second would be moving averages and just the direction and just understanding the trend and how it's evolving. Momentum, and then relative performance. And those are the 4 things that I generally consider when I'm looking at a chart. PPO is another one that I do. And anytime I find something that's like in a big downtrend and just starting to turn, I'll often put the MACD or PPO just as a more systematic way of identifying sort of the early upside rotation. But on a chart like this, I wouldn't probably put it on there because I don't feel like I'd necessarily need that. And that's it. And I think recognizing that there's an order to what you do, starting with price, going through other things, I think is important. Noting that there's not many indicators on here, I think is important as well. So I think for a lot of people just getting started, you want to lighten up, look at less. Less is more when you're just learning the toolkit. Does it change between stocks and indexes? Between like stocks and equity indexes, not really. And I primarily look at ETFs because I find, especially liquid ETFs, meaning actively traded ETFs, great data, plenty transparency, and I think you can rely on the data very, very well. If you're looking at other things like commodity ETFs or currencies or, things that, cryptocurrencies, things that are different than stocks and ETFs, then yeah, maybe I would use some different toolkits. An example would be like commodities like, gold, energy, a lot of times are more mean reverting. Just the dynamics of the sectors are a little bit different. So maybe I would do different tools that are more looking at mean reversion as a main toolkit. But generally speaking, 90% of the time, the chart that you see in front of you is kind of my default chart. The other thing I would say on this, and this is a lot of the work that I do with the Market Misbehavior Premium members, is help people get to a structured approach as opposed to just kind of a one-off, well, look at the moving average. Oh, this time look at the RSI. Oh, wait, over here, look at the MACD. What you want to have is a consistent, disciplined approach. Think of it like a checklist. Here are all the things that I look at, and here's what the weight of the evidence is telling me, and this is whether I should buy or sell. That's where I hope you can get to for sure. Thanks for that question, by the way. Next one. What are your thoughts on the market making all-time highs into late January and then dumping using something Trump does as the excuse to get that 10 to 15% drop? I love the cynicism in your question. I had to share it with the whole community. So a couple of comments. This came actually earlier, about a week or two ago, and I wanted to share it today because it is the end of January. So, first off, in your question, spot on. I mean, the market did rally into late January for sure. I mean, we're kind of testing new all-time highs today, right? Pushing above 6,100. It looks like we're closing a little weaker. We'll see what happens in the last hour and a half of trading, but certainly generally, I mean, medium-term, long-term trends certainly quite strong at this point. So I think that was a pretty fair assessment. And also, if you listen to my recent podcast episodes with Jeff Hirsch of the Stock Traders Almanac, Sam Stovall of CFRA Research, we talked about the January effect and that seasonal story of looking at what happens in January. When January's up, that usually means the entirety of the year is going to be positive, and looks highly likely that's what's going to happen in January of 2025. Most Januaries are up more than they're down, to be honest with you. Now, the next part of your question is an interesting one. Dumping using something Trump does as the excuse to get that 10 to 15% drop. I mean, it's tough. I mean, and there are times when analyzing the markets does not feel like a political debate. There are other times, and I feel like the last 3 months or so, from kind of the election, right around the elections in November, all the way now through the end of January, it's been it's hard to have a conversation with one of my podcast guests without Trump coming up in some way. And I don't blame them, and I don't blame the fact that we have to go there, because, certainly there are a lot of things that the president could do, especially given the early indications of aggressive policy changes, unwinding a lot of things that have been in place for the last 4 years here in the U.S. And again, the ripple effects of that, I would say, are very much debatable and hard to really understand until they get implemented, and then you figure it out. So I think it's, again, blaming the president for what happens in the markets. I would say, analyzing the markets in January of 2025, you have to think about potential policy decisions, and then you're making a ton of assumptions about what they mean. An example of that, I would say, would be the Trump tariffs. Now, I've talked a lot on the show, and certainly it's been straightforward to me. It's been very reasonable to assume that tariffs imposed on non-U.S. products coming in the U.S. are most likely inflationary, because if things cost more to get into the hands of consumers here in the U.S., most likely that higher cost is going to be passed on to the consumers in the form of higher prices. And that is what inflation means, right? Prices going up. So hard for me to assume that tariffs would not be inflationary to some degree. Now, what's debatable is how much, right? Maybe it's a little impact and we don't even notice, because there's all these other, it's not like it's just tariff. A lot of times we think of something like tariffs in a vacuum, right? Here's one policy decision on immigration or tariffs or tax policy or, military spending, whatever. And then we make all these assumptions about, well, that happens. And so what does that mean for these stocks? We have to remember there are a bunch of different things happening at any given time. DeepSeek AI, right? I mean, if Trump comes up with a tariff announcement and DeepSeek AI is announced on the same day, what's the net result? Like, I'm not sure. And that's what investors have to deal with, is the fact that these sort of decisions, are not one-off things, and they don't happen in a vacuum. The markets are a complex mechanism, combining the net result of all these different things and really the expectations from investors about how they could impact the markets going forward, and impacts companies' abilities to grow revenues over time. So So again, I think it's, we love to sort of take one particular thing and think, is that bullish or bearish? Which you have to remember is that's just one thing, and there are a bunch of other things happening at any given time. So this is one of the many reasons why I'm a huge fan of charts and technical analysis, because while I love to debate what the charts might look like tomorrow, at the end of the day, we can analyze what's happening with price today. And that is not open to debate, right? Buyers and sellers came to agreement at a certain price. The trade is printed. That is now fact. That is not debatable. That's not opinion. Price is fact, as one of my mentors, Ralph Eckenpour, loves to scream when he has a microphone in front of him to a crowd of young, impressionable investors. So I wouldn't blame anything on one particular thing. I think seasoned investors, mindful investors know that the markets are complex. There are a lot of different inputs. I would spend less time debating and trying to figure out what one thing like a Trump policy decision could mean for markets, and just reflect on the fact that there are a lot of things influencing stock prices at any time. Use charts to sort of get the aggregate reaction of all of those different inputs. That was a soapbox moment about the benefits of technical analysis. Hope you found that helpful. Next question, thoughts on BLDR year to date? It's up a lot, undeniably so, I would say. Let's look at a Builder. So this is Builder's first source is in the industrial sector. So immediate reactions, right? This is one of those charts where I feel like when you bring it up, literally take a couple steps back from your monitor and sort of what's the overall trajectory, what's the overall trend, like what stands out to you. I am personally, and I'll tell you what stands out to me is what we call a coil pattern or a symmetrical triangle pattern. That's where you have it's like the most illegible line in technical analysis history. Let's make that like a green. Okay, there we go. Lower highs, higher lows. This is called a symmetrical triangle or coil pattern. It doesn't matter what happens leading into the pattern, but you have this narrowing of the range, lower highs, higher lows. Look how the moving averages are relatively flat, kind of in the middle of the range. What this is telling you is the market for the last almost 12 months says this stock is worth around $165 to $170 a share. And we've just kind of been undershooting and overshooting that equilibrium price. And as of today, we're literally almost at the median price between those two extremes. So this sort of pattern, a coil pattern, tells you we're in a consolidation phase. And probably the weekly chart, better than anything, will make this kind of jump off the page at you. Let's see. Yeah, you see this, right? So if you look at this chart, this is why we talk about price patterns, right? So here's a clear, I think, coil pattern, which is lower highs and higher lows, right? So an uptrend is higher highs and higher lows. A downtrend is lower lows and lower highs. A sideways trend or a consolidation phase, lower highs, higher lows. So we were narrowing the range. We're kind of settling in to an equilibrium. At this particular point, I think it's a neutral. I think you wait to see which way we break. And at some point we break above the upper trend line or below the lower trend line. And that's what would tell us that the trend is now is new, right? There's a new accumulation phase if we break out to the upside. It's a new distribution phase if we break down to the downside. And the direction of the breakout is probably the primary direction going forward, at least for the foreseeable future. So I would see this as kind of a neutral chart. Now, if you have the ability to more swing trade, do more short-term trading, I'd use something like the MACD or PPO. Here's the weekly version. You can use it on the daily version as well, and just look at the crossovers identifying these swings. So if your goal is to just bet on longer term trends, I'd be waiting to see where it breaks out. If you're able to trade within this range, that's what's great about sideways markets. You can use option strategies like straddles or strangles. You can use PPO and just do little directional trades, betting on swings within that range. A lot of ways you can make money within a sideways trend as long as you use more of a shorter term time frame. There you go. Hope that was helpful. That's sort of my overall take on Builder. Certainly up a year to date, just at the beginning of January again. But I think that overhead resistance using the trend lines from 2024 would probably tell me, limited upside unless we can break above that level. We're going to continue on with a couple more questions here in a moment, but I do want to remind you we have a Market Misbehavior premium membership. It's something we love to promote because I've gotten great results helping individual investors improve their market awareness. You go to marketmisbehavior.com/premium for more information on our premium memberships. If you like what we do here on the show, if you like the way that we analyze the markets and you want to improve your own ability to apply those tools and techniques for your own portfolio's benefit, go to marketmisbehavior.com/premium. 3 things that are included: virtual courses, an online community, members only, where you can ask questions and hear what others are asking and hear how I'm answering their questions as well. And some members only reports like our weekly flight plan, our monthly chart review, which will be coming up next month. So if you join soon, you'll get that latest monthly chart review where we apply our proprietary market trend model to a bunch of different asset classes and talk about big picture themes and rotation. So marketmisbehavior.com/premium. I hope you'll consider joining as a premium member. It'd be great to have you. Next question. Dave, can you apply your market trend model? Great. With the long-term, medium-term, and short-term indications for individual stocks, or is it only meaningful for indexes? Yeah, so I mentioned that earlier. Thanks for asking about the market trend model. The short answer is you can apply it on anything. So like builders, which we just looked at. So I actually have it as one of the sort of quick buttons here on stock charts. So again, methodology is the same, right? And so you definitely, the short answer is yes, you can apply it on individual stocks. Do I do this often? I normally don't. Some of my premium members actually over the last couple of weeks have asked about scanning for stocks showing some of these rotations, and I'm intrigued by that. And it's on my rainy day list. It's raining today, so maybe today's the day I start to dig into that a little bit. But for sure, I designed this to understand the S&P 500. I quickly found it was helpful comparing the trend configurations on these timeframes for other asset class, other indexes like mid caps and small caps, other asset classes like gold, the dollar, cryptocurrency. So I run it on all of those things for our monthly chart review. That's a big part of that, members only presentation that I give once a month. And I would say for individual stocks, you certainly can, because the idea of this is it's trying to just quantify the trends on 3 different timeframes, the ones that are most important to me. So, the long-term time frame actually just turned negative for the first time since 2022. So it's been bullish through this whole period. But there's been enough of a downside rotation, just turned bearish at the end of last year. Medium-term model turned bearish here beginning of December, still technically bearish. We'll see what happens as of Friday's close. The short-term model just turned bullish here in January. And previous question, you mentioned year to date, it's been up a lot. That's enough for the short-term model to turn bullish, but medium-term and long-term are still bearish. It's kind of how that chart would feel to me. And this is just a zoomed in version, so you can see the signals a little more clearly. So yes, I apply it to equities indexes. Primarily, it's to broad ETFs tracking the major asset classes, and main market trend model for me uses the S&P 500. That's what I designed it for. That's where I tested it and sort of optimized it. But again, I found it super valuable looking at other things. I'm excited actually to think about adapting that and starting to scan on stocks showing rotations on some of those timeframes. And I'll share all those results with my premium members for sure. All right, next question. Dave, what are the basics of point and figure charts? I hesitated putting this question in. I did get this question, and I appreciate so much. I don't show a lot of point figure charts on the show. I wish I did more. Note to self to try to remember to do that. I hesitate only because that's an hour-long webcast at least to really get through even the basics of point and figure chart. But I'll give you the quick couple-minute long version. Point and figure charts are a methodology that was created many moons ago. By traders and basically, I mean, the way I would summarize it, it was really popularized in the pits of Chicago, looking at the commodities markets. Couple people, Chartcraft, Abe Cohen is the name. Abe Cohen was at a firm called Chartcraft, where they did a lot of point and figure charts. He really popularized them in the U.S. Others like Tom Dorsey, who eventually sold his firm Dorsey Wright to NASDAQ, but wrote a number of books on point and figure charting. Jeremy Duplessis, who helped start the charting platform UpData, based in the London area, also has written some really good books on point and figure charting. I consider those guys the experts. And I'm thinking I should have Jeremy and or Tom on the podcast. I'll see what I can do along those. I'm going to actually jot that down. There we go. Point figure charting was really created as a simple way to chart trends. It was traditionally done by hand on graph paper. And some people like Louisa Mata still has hand-drawn point and figure charts. I don't know if she's still keeping them updated, but I remember she would come into our Fidelity office and unwrap these huge wall-sized point and figure charts where every day she's updating the X's and O's, tracking the uptrends and downtrends. And that was really continuing the work of her mentor, Alan Shaw, at Smith Barney, who was really taught a whole generation of technical analysts. My mentor Ralph Atkampora as well, and thousands of others taught at the New York Institute of Finance for years before Ralph took over that class as well. Point and figure charting was traditionally done on graph paper with X's and O's, so it was easy to do. You only had to look at the markets at the end of the day using the main version, which is a 1x3 point and figure chart. What a 1x3 means is the 1 is the box size, so every box represents 1 point. Now, when you get to a higher price level, so when you get a stock trading in the upper hundreds, each box represents 5 points. So point and figure charting actually has a primitive version of log scaling, because if the stock was below $20 a share, boy, I'm going to butcher this. If it was above $20 shares, it was $1 per box. If it was between 5 and 20, it was like 50 cents per box. If it was below 5, it was a quarter a box, I think, something like that. So it was a kind of a primitive log scaling that was used. Pretty cool how it was designed in a way that was easy to do by hand and easy to just look at the prices at the end of the day and update your point and figure charts. So how does this work? If the market's in an uptrend, you're in a column of X's, and every time we make a new high that gets into the next box's range at the end of the day, you add another X. And so as long as the uptrend continues, you keep making new highs, you add X's. If you stop making new highs, then you start to check the lows. And if the low goes at least 3 points to the upper side, so it's to the other side, so it's a 1x3. 1 is the box size, 3 is the reversal count, so 3 times the box size going back. So if the stock would go down at least 3 boxes worth, then you go to a column of O's. So what that does is uptrends are X's, O's are downtrends. Tom Dorsey, in a couple of his books, relates it to football. And basically, when the X's are there, the offense is on the field. If you're in a column of O's, the defense is on the field. Traditional signals, the classic signal would be a double top breakout, where you have a column of X's and then another column of X's goes 1 box higher. That's called a double top breakout. So we just recently, for Eli Lilly, have a double top breakout. The opposite, a column of O's that goes below the previous column of O's, would be a double bottom breakdown, which is the classic sell signal. There are other more complex buy and sell signals. Stock Charts has a pretty decent point and figure engine, also allows you to screen on point and figure signals. Two platforms I've used with excellent point and figure charts. Stock Charts would be one, and Updata, because Jeremy Duplessis, who wrote the book on point and figure charting, helped design the charting platform, and so it's very, very well done. There are also objectives like the vertical count and horizontal count. There are trend lines you can draw. These are 45-degree lines that are drawn as a way of giving additional color and looking for breakouts and breakdowns. That's as well as I can do in about a 5-minute breakdown of point and figure charting. What I love about it is it's meant to eliminate the noise of day-to-day price action and simply look at trends when they break out and break down. So scanning for stocks making double top breakouts, if you want to learn the value of point and figure charting, I would look at that on Stock Charts. It's pretty powerful. So if you go here, charts and tools, go to predefined scans. Yep. And then go down here to point and figure patterns, double top breakouts. Look at like NYSE names. That's not a bad starting point. You can see some of these names that are having point and figure charts. Look at the point and figure charts then, and then and then see what the patterns look at. And you'll see that it's a great way of identifying breakouts earlier in the move, which is why I used it earlier in my career. I used them actually quite heavily. I've just gotten away from it more recently. So thanks so much for asking about point and figure. You note to self, maybe I'll do a webcast at some point, digging into that in a lot more detail, just turning what I just did into an hour-long discussion and having a lot more examples. Point taken, and I'll jot that down. Point taken, and pun intended. Last question, we'll call it a week on chart this. Do you see a bull flag violation on the weekly chart of GEV? What about the daily chart? So GEV is one of the GE spinoffs. If you know, GE kind of spun off into a couple different things. You had the financial part, the aerospace part, and everything kind of split off into different things. So you're talking about this is GE Aerospace. You're talking about GEV, which is GE Vernova, which is this chart. So this IPO really was spun off almost a year ago now, end of March of 24. So let's look at like a 1-year chart. And your question was, do you see a bull flag violation on the weekly chart? Let's look at the weekly chart, and we'll do like a year. It's not a lot of weeks so far. Do I see a bull flag violation? So I don't, and the reason is because I don't see a bull flag. Not sure how you would be calling anything on here a bull flag. So a bull flag would be a big uptrend, and then a bull flag would look more like this. And maybe this is what you're talking about. Bull flag would be like down like this. So if you have like a big uptrend and then kind of a short term lower highs, lower lows, and then a breakout, the breakout there is what would complete a bull flag pattern. That's what a bull flag would look like. A bear flag would be the opposite. If you have a downtrend and then a short upswing. So I don't really see a bull flag. And maybe you're thinking of like this. Maybe you're thinking of this as like a little flag pattern. Like it's more of a consolidation than a flag pattern for me. So I don't know about that. I mean, I definitely would say with GE, it's about the breakout out of this range and now coming back. And maybe that's what you're getting at. So let's look at the daily chart here. And again, I apologize if I'm not seeing the pattern you're talking about. So I don't see anything on this that I would call a bull flag. I would tell you the way that I would think of this from a technical perspective. Think of these kind of range things that I like to draw. So you have this rally phase here, and then here you kind of have this rectangular pattern. So I would call that a basing pattern. A basing pattern is anytime you can kind of draw a rectangle and it captures most of the price action. That's called a basing pattern. It's just a sideways trend. So you have an uptrend phase, a downtrend phase you really haven't had a lot of, but you do have a series of these kind of consolidation patterns where we're kind of sideways for a while. Then we break out and then continue higher. And we got that at the beginning of January. So I think the chart of GEV looked really, really good. Now we broke higher, but then came right back in. And I would say this probably then I just continue to think of this. If I'm, I wouldn't be opposed to kind of taking some off the table on that gap lower. If that's like, okay, something's different, I need to take half of it off. I wouldn't have a problem with that. I probably would do the same. We've broken below the 50-day moving average. Now it's kind of in the middle. But I think breaking below 320, getting below the lower end of that range would be the problem. So for me, below there is a pretty broken chart. Above there is okay. Outside of that, making a higher low and just sort of resuming this uptrend would be what's most important. From inception here in March of 2024, it was sort of a classic uptrend, consolidation, uptrend, consolidation, uptrend. Now all of a sudden this is different. This first big downside gap since the beginning of the stock about a year ago. So does it hold, that lower end? And if not, I would be getting out of the way. Until then, I think it's a neutral chart at best. There we go. Those are all the questions today. I want to thank you guys so much for joining me here on the all mailbag edition on Friday. Thank you for all those questions. All those questions came from people like you over the last week or so. And again, I really appreciate seeing what you're questioning about, what is standing out to you, what kind of themes and things like point and figure that you want me to dig into. Really helps me think about how to improve the show over time. I can't tell you how much I appreciate you tuning in live and also watching the replay. Either thing that you do, I'm joyful for that. Also, as a reminder, we've had some really good interviews on the Market Misbehavior podcast. Just in the last week, we've released 3 episodes. On Monday, we released an episode with Jeff Hirsch talking about S&P and Bitcoin seasonality. On Tuesday, Peter Bukvar. We talked with Peter, editor of the Book Report, on Fed policy, on interest rates. It was a great kind of pre-Fed discussion about what kind of things to look for. And then just earlier today, I released my interview with Jay Hatfield. He's the CIO at Infrastructure Capital Advisors, portfolio manager of a number of popular ETFs, a number of which play on alternative asset classes. We talked about his year-end forecast of S&P 7,000, how he backed into that. Some really interesting comments about Trump tariffs and tax policy and all the other things. Really helpful to kind of round out my understanding of the markets. And I hope you find those good conversations to enjoy as well. You can find those on our YouTube channel and now more and more on all of the podcasting platforms. Have a great weekend. For Market Misbehavior, I'm Dave Keller. And remember, it's always a good time to own good charts. Take care, folks.